Accounting 201 students, this will be the last PowerPoint for Chapter 2, a further look at financial statements. We will explain the meaning of generally accepted accounting principles, which we sometimes call GAAP, and discuss financial reporting concepts. To develop accounting standards, the Financial Accounting Standards Board, or FASB, relies on some key assumptions. These assumptions follow. The first one is monetary unit. Requires that only those things that can be expressed in money are included in the accounting records. The next one is economic entity, which states that every economic entity can be separately identified and accounted for. Periodicity states that the life of a business can be divided into artificial time periods. Going concern, the business will remain in operation for the foreseeable future. And the last one, accrual basis, our transactions are recorded in the periods in which the events occur. GAAP generally uses one of two measurement principles, the cost principle or the fair value principle. Selection of which principle to follow generally relates to trade-offs between relevance and faithful representation. The cost principle, or historical cost principle, dictates that companies record assets at their cost. This is true not only at the time the asset is purchased, but also over the time the asset is held. For example, if land that was purchased for $30,000 increases in value to $40,000, it continues to be reported at $30,000. The fair value principle indicates that assets and liabilities should be reported at fair value, the price received to sell an asset or settle a liability. Fair value information may be more useful than historical cost for certain types of assets and liabilities. For example, certain investment securities are reported at fair value because market price information is often readily available for these types of assets. In choosing between cost and fair value, the FASB uses two qualities that make accounting information useful for decision-making: relevance and faithful representation. In determining which measurement principle to use, the FASB weighs the factual nature of cost figures versus the relevance of fair value. In general, the FASB indicates that most assets must follow the cost principle because market values may not be representationally faithful. Only in situations where assets are actively traded, such as investment securities, is a fair value principle applied. The full disclosure principle requires that companies disclose all circumstances and events that would make a difference to financial statement users. If an important item cannot reasonably be reported directly in one of the four types of financial statements, then it should be discussed in notes that accompany the statements. There are some constraints in financial reporting. Efforts to provide useful information can be costly to a company. Therefore, the profession has agreed upon constraints to ensure that companies apply accounting rules in a reasonable fashion from the perspectives of both the company and the user. The constraints are materiality, which is an item immaterial when its size makes it likely to influence the decision of an investor or creditor. It is immaterial if it is too small to impact the decision maker. If the item does not make a difference, the company does not have to follow generally accepted accounting procedures in reporting it. The other one is a cost constraint. It relates to the fact that providing information is costly. In deciding whether companies should be required to provide a certain type of information, accounting standard settlers weigh the cost that companies will incur to provide the information against the benefit that financial statement users will gain from having the information available. Let's do it together. It says the following are characteristics, assumptions, principles, or constraints that guide the Financial Accounting Standards Board when it creates accounting standards. And you have the ones we just talked about: relevance, faithful representation, comparability, consistency, monetary unit assumption, economic unit assumption, periodicity assumption, going concern assumption, cost principle, full disclosure principle, and materiality constraint. So we're going to match each item above with the description below. The first one, the ability to easily evaluate one's company's results relative to another's. Which one would that be? Comparability. The belief that a company will continue to operate for the foreseeable future. It's going to go on and on and on. Going concern. The judgment concerning whether an item is large enough to matter to decision makers. Materiality constraint. The reporting of all information that would make a difference to financial statement users. That would be full disclosure. The practice of preparing financial statements at regular intervals. Periodicity. I had to listen to that on dictionary.com. The quality of information that indicates the information makes a difference in a decision. Relevant. Excuse me. Belief that items should be reported on the balance sheet at the price that was paid to acquire the item. Cost. A company's use of the accounting principles and methods from year to year. Consistency. Tracing accounting events to particular companies. Economic entity. The desire to minimize errors and bias in financial statements. Faithful representation. And reporting only those things that can be measured in dollars. Monetary unit. The review question. Can you see them? What is the primary criterion by which accounting information can be judged? Is it consistency? It is comparability. I don't know if you can see that on there. For your assignment, I'd like for you to complete exercise E12, and it is an exercise where you're going, much like the do it that we just completed. Good luck, and I'll talk to you in chapter 3.